This is part two of value investing and risk taking. The discipline of value investing involves treating one share of stock or 100 shares of stock in the same way you would treat buying an entire company. That is, finding the intrinsic value of the company and then paying much less than its true value. If the company, if for example a share of stock was worth $50, that is all the shares of the company added together would equal the true intrinsic value of the company, and you could buy that at $25, then the company would generate earnings, free cash flow in the future that would justify the $50 price. You're buying it at a discount because most people are momentum investors. They become excited when things are going up, and they think they can only keep going up. And then when things are going down, they sell at the bottom. This is what most amateurs do, and a great many professionals. But if you go out of your way to establish the intrinsic value of a company, you don't get trapped this way. You take advantage of the bargains, and you hold on while the company achieves its intrinsic value in share price. Now, if you make a mistake in your calculations, then you'll get burned. But you have as much opportunity as any professional to find out what a company is really worth. Morningstar, which is a value house, provides an online service in which they try to estimate on a 3 to 5 year basis the intrinsic value of companies they follow, 2,000 companies. That's one thing to look at. But they get a whole lot of them wrong because it's very difficult to predict future earnings. Now let me explain free cash flow. When you pay all the bills of a company and make all the capital expenditures that are necessary to keep the company operating, whatever is left, whatever is available to the company to do what they want, to pay it out to their shareholders in the form of a dividend, to pay down debt that they incurred in the past in order to build the business. Or if their stock gets very, very cheap, to go into the open market and buy back shares at 25 that will someday have a value of 50. Now, the ability to generate free cash flow establishes the value of the company. Now, look at a U.S. government bond. Let's say you bought a $100 bond. A 10-year bond today pays 4% interest. That is, they would pay you $4 a year for 10 years if you held the bond, and then they would give you your $100 back. But in 10 years of 3-4% inflation means that every year the $100 that you put up would buy less and less. And by the time you get it back in 10 years, it might have a purchasing power of 40 cents. But they've been paying you 4% each year, $4. And so that might just cover the inflationary shrinkage. And that's what's happening now. But what if a company generated for each dollar of share price, or let's say a company that has a $50 share price and that's generating $5 over and above all their expenses and their normal capital outlays, it would be yielding 10%. If they wanted to, they could pay it out in a dividend, or they could pay out, say, $4 of the $5. They could pay out, say, $1 or $2 in a dividend. They could take $2 and pay down past debt, which means they'll have lower interest payments in the future. Now, how do you determine whether the cash flow, the free cash flow, which is easy to determine today? You go to the company's website, they have their earnings, they have their entire financial statements online. If you have an online brokerage account, and an online brokerage account means that your costs will be almost as low as professionals. And there's so much competition that the broker will provide you with a lot of free research. Not their opinions, but a lot of information that you can analyze on your own. So, I'm going to be on what I was looking for. Now, how would you determine the future free cash flow of a company apart from today's free cash flow? Well, if it's in a business that's likely to grow, for example, the world is facing a water shortage. The western part of the United States is facing a water shortage. The more oil that's produced from the tar sands of Canada or from oil shale in the United States, the more water will be used. Most of the world drinks contaminated water. Most of the water available in the world is barely suitable for agriculture. So, companies that are involved in helping to purify or increase the amount of water available anywhere in the world where you have economic growth could be good. Some examples are a company called Aecon. I'm not recommending this. I'm just telling you this is the kind of company that is likely to have growth in the future. Another way to estimate the future free cash flow of a company is look at the value of the assets that they own at the moment. Oil companies have reserves. Reserves that they will produce 5 and 10 years from now are very, very valuable. And you can estimate what this value is. So this will be continued in part 3